Hello, I'm Liz Lumley of Finextra, and today I'm speaking to Robin Feith of the Building Societies Association.
Morning, Liz.
Morning. So a huge topic in banking right at the moment is this increasing digital world we all live in. So what are some of those sort of tough technological questions that building societies need to ask but might be afraid to?
I think let's start at board level, shall we, with what are the two things that building society boards really need to be thinking about. And I guess the first is IT risk, and that's the risk of doing it and not doing it. And I think one of the real challenges of providing proper services to customers now in the 21st century is the huge spectrum of service opportunities or the ways in which customers want to transact with their building society or their bank. So when I started out, you had a passbook, and many building societies still do have passbooks, and they have branches, and customers like to go into branches and transact in the old-fashioned way, or the traditional way, if you like. But at the other end, of course, we all love internet banking, don't we? And the whole spectrum of the way in which business is done nowadays is just far more complicated and far more varied than it was 20, 30, 40 years ago. So I think that there is that whole risk thing. What do we do with IT? What don't we do with IT? How close to the leading edge do we want to be in terms of apps, in terms of mobile banking, in terms of things like like PayM, which one or two of our societies have just signed up to. So those sorts of arrangements. The second really big thing that building society boards need to be thinking about is cybersecurity. So how secure are their systems? How do they deal with the potential risk of loss of customer data or personal information and those sorts of things? So that's I think is the frame in which all of these technology debates have to take place, and of course all of that in a highly regulated environment.
So sort of looking at your IT environment with all the different channels that customers want to interact with the building societies, whether it be, as you said, the old-fashioned passbook or a branch to internet mobile banking.
Indeed, and of course you can't even segregate that by different types of customer or member, because typically all of us will want to do some things by going into a branch. If we're going to get a mortgage, we might not be so comfortable doing that online. We might actually want to sit down and talk to someone and talk through it and talk through the options. And typically that is still done on a physical meeting rather than using Skype or video technology. On the other hand, most of us, and I'm certainly one, I tend to do my sort of payment type banking at about 11 o'clock in the evening, and I probably don't expect the branch still to be open at that time, although I might expect the call centre to be open. And that range of services, I think, is the real challenge.
So, I mean, consumers today are offered a wide range of financial services products. What is unique about building societies? I mean, what do they offer consumers?
At their core, they offer retail savings and they offer mortgages, residential mortgages. That's the core of the building society business. So most of them are not full transaction type banking relationships. Most of them do not have current accounts, do not do unsecured lending and those sorts of things. What makes them, I think, very special is that all building societies are mutual. They are owned by the individuals who have their savings with a building society or who take a mortgage from a building society. And that makes there are two really key distinctions in that. The first is that there are no external shareholders. So there is no need for an external dividend to go out. And that tends to reflect back in savings rates and mortgage rates. So when you look at, and interestingly I think, when you look at the long-term rates, when you look at what we call the back book on savings rates, building societies tend to do much better than banks. They might not do quite so well sometimes on the teaser rates, if you like, the promotional rates, but anyone can put an easy, a very attractive offer into the marketplace. The question is whether they then, as soon as you come off that bonus rate, you end up earning no interest, etc. So I think there is that real distinction first, that there are no shareholders. And the second, which really does show it through in behaviours, is that because building societies are owned by their members, their customers, those who save and those who borrow, those customers tend to be far more at the heart of of how the building society does business. And I think that probably shows best in things like satisfaction tables. So in one of the most recent ones, 66% of building society customers are happy with their building society, compared with only about 40-something% of banks. And I think that that sort of level of satisfaction really does show through. It shows through in things like uphold rates from the Financial Ombudsman Service, where so people make complaints about either mis-selling or having been dealt with unfairly. The uphold rates on building societies are incredibly low compared with some of the banks. And I think those are the sorts of things that show that building societies tend to behave in a way that recognises that their customers are also their members.
It seems, I mean, there are a lot of issues with banks currently about issues of trust with consumers. So that seems to be put building societies on the right side of that type of trust.
I think that's right. I mean, and trust is that. I mean, it's such an intangible, isn't it? But trust is so important in every business relationship we have. But particularly, I think, in those banking and building society type relationships, do you really trust your provider, your building society, to do the right thing? And we certainly expect our members to do the right thing, and I think their track record is pretty good on that.
So,
not to say they're perfect, but none of us are, I think.
So, I mean, despite that, though, what are some of the barriers that building societies face that's stopping them from fulfilling their true potential?
I think there are whether they're barriers or whether they're challenges, and of course we can see both sides of the coin here, I'm sure. Issues. I think that there are three major challenges at the moment that perhaps we should reflect on. The first is capital. So, because building societies don't have external shareholders, the way they typically raise their capital is through retained profit. If there is a demand for capital to be raised quickly, and that might be because the sector's growing very quickly, they want to grow faster and take a larger share of, say, the mortgage market, then they need more capital. Or it may be to fulfill some of the regulatory requirements that are coming out of the crisis. So, as we all know, all banks and building societies are being required to hold more capital from a prudential point of view. So raising that capital is a real challenge. And so far, only the very largest societies have actually found an external way of raising capital, so a way of raising capital that meets the capital requirements from a prudential point of view, whilst not just relying solely on retained profit. I think the second that comes with that is the whole regulatory environment. And one of the things that has really struck me coming into the sector relatively recently is that all the talk we have about proportionate regulation tends to be regulation, interpreting that regulation that has been developed primarily for a multinational and corporate banking model, proportionately or less badly, if you like, to a mutual model. So I think we should be talking far more about appropriate regulation. And what I mean by that is a regulation that recognises that we want a financial services sector that is truly diverse, that is far more resilient and competitive by having a diversity of business model and ownership structure, and therefore champions that diversity rather than restricts it. And one of the fears I have about regulation of all sorts is that it tends towards homogeneity. It tends towards trying to create entities that are the same, that can be compared with each other, that look alike, that are actually easier to regulate. What we really want, if we want a resilient sector for come the next crisis, and a highly competitive sector, is a huge diversity that in a crisis at least has the opportunity to respond and react in different ways. So I think regulation is the second big issue. And the third big issue, which comes right back to the heart of building societies, is actually how they govern themselves. Because if you like, the moral hazard of not having external shareholders, not having those hedge funds on your back or those activists who are holding directors to account, is that if your own governance is not absolutely spot on, then the risk is that you slip into a downward trend. Complacency is probably the biggest risk, I think, that affects the boards of any mutuals and cooperatives. And that is, it shows out in those that have not succeeded over the years, whether they be building societies, whether they be other organisations. So I think we're certainly looking at a project this year which is going to be talking about what does distinctive, excellent governance look like for building societies, and how do we keep the sector safe and developing so that in the next 20 or 30 years we still have a vibrant and preferably growing building society sector.
Excellent. Robin, thank you very much.
Thank you
Appreciate
very
it.
much.